Hello, welcome back to Accounting 2302. Doom 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 with your host, Professor Naragon. Yeah. Thank you. I am back coming with Chapter 21 with fixed and flexible budgets. Yes. I'm trying to stay a little bit off the monotone voice, but I cannot help if that does happen as we zoom in. Now, we're going to be mostly analyzing a lot of this in those 3-month quarters, stuff like that. That's what we've been doing in Chapter 20. That was the master budget. So now we're dealing with more known as fixed and flexible budgets. And this chapter also will look into what is known as standard costs. Something that we've predetermined costs of producing a particular unit and seeing how that compares against the actual. So, a lot of fun stuff. This chapter is going to be a tad bit long, but gives you a lot of valuable information of how these internal managers figure things out. Alright. So, first little part that we get is what is known as a fixed budget. And these are also known as static budgets, or basically, again, something that really doesn't change a lot. They're very fixed in the way they are. And how we get it. Basically, this is how the master budget is done. It's a critically assumption must be made regarding the level of activity that is applied. The problem is with using a fix, it becomes very hard to compare. And the reason why, when we look at this, is that right here you have 10,000 units, and the fixed budget's based on that, when our actual results are 12,000 that we sold. And just that slight difference of 2,000 units can throw everything off on the budget. We don't have a proper comparison. But when we look at this, if we do compare, notice that we do basically subtract actual from fixed. And they'll come out with their numbers of which one's greater and which one's lesser, either negative or positive. And when we look at these, if sales is positive, you see this little F. This F stands for favorable, means something we like. Well, it doesn't work very well with expenses, because we don't want to see expenses be higher actual than what we budgeted. So that's an unfavorable thing. And then to get this income from operations, basically again it's just taking your favorable minus your expenses, so sales minus expense, and that gets us this. Notice it's positive, we love it, it's favorable. If it was negative, it would be unfavorable. But again, this runs a problem. We can't accurately tell our managers if they're doing something well or something bad, because we're not comparing correctly. This is that classic scenario of apples and oranges. Yes, they have some of the similar qualities, but they're not actually the same. So for managers and us as accountants, we come up with another budget known as flexible. So right here, part of your notes, this is just explaining a little bit of what favorable and unfavorable is. Again, favorable budget revenue is less than actual, budget cost is greater than actual cost, and we love that. Unfavorable, just the opposite. So I'm not diving too much deep into those for that fact, but it's really why we need to use the flexible, and that's why I've been basically explaining, just not going through all the words. But of course, these are a few questions that we ask. Just to backtrack and give you the questions. These budget performances reports that we use basically do help managers monitor and control operations. Some of the questions they may ask just from this fixed is one, why is actual income from operations higher than budgeted? They're going to ask that, they're going to try to figure out because they want to reproduce that. Is manufacturing used too much direct materials, too much direct labor? Because those had a higher expense than actual. Why was sales commission higher? Why are there so many variance unfavorable? Why do we have so much? And that what brings up that issue. And again, right here, states again, this is the issue of comparing those two different results in units. So, flexible budgets, which you can see right here, is basically also known as variable budgets. Again, fixed, variable. We love throwing those terms. Those terms are awesome. So, the flexible budget is basically based on different selling amounts, different units of sales. And it gives us this kind of like what if scenario. And yeah, what if you're a comic book fan, you probably know the what if from Marvel. That one is one I actually do like was some of these Spider-Man and Deadpool. Deadpool kills the Marvel universe, which you probably could. I don't know, but I'm getting sidetracked. Anyway, it is a what if scenario, and these budgets are made and they're really trying to get based on actual activity levels. So when we look at it, we're going to have the 3-step method again. 3 steps, give me 3 steps. Yeah, and just get it, rock on. And so in preparing a flexible budget, our first step will be identify the activity level. How many units produced or sold that we're going to use. Okay. Step 2 is going to identify the cost and classify them as either fixed or variable within the relative range of the activity. Usually that's again mostly going with our big 3, direct materials, direct labor, and factory overhead. But now we also throw in some of the G&A stuff like sales commissions and other items like that. Step 3, we're going to compute budget sales revenue, then subtract sales revenue from total budget variable cost, as well as from budget fixed cost. Basically, our income statement. So, again, we're getting to that contribute margin that we've done in prior chapters. So, our flexible budget, variable costs are either expressed as dollar amounts per unit or percentage of sales. We're going to deal mostly with dollars per unit in this chapter. We're not going to go too much of a percentage unless we're looking at capacity. So with this is usually our example. This time, instead of using that fixed, we spread it. So now we got 3 activity levels. We have it if the factory basically sells 10,000 units, 12,000 units, or 14,000 units. And we run through the cost basically the same. One, we will know the variable amounts by using prior stuff in our chapters, or these numbers will be given to us for this course. But these we find out on a per unit base. How much would it affect per unit? Now, of course, sales is $10 per unit, so 10,000 times 10 equals that 100,000, 12,000 times 10, so forth and so on. And then it's just the same thing. Multiply your units by your variable cost. Boom, boom, boom. And when we get through here, we're going to find the contribute margin. Now, contribute margin on a per unit base is $5.20. Again, that's your sell minus your variable cost. And we do the same over here for each production. So how much variable cost minus from our sales. Okay. Next, we got our fixed cost. Of course, we already know fixed costs are costs that just do not change. And again, some of this is overhead, so watch out because depreciation on machinery will be actually factory overhead, but it's more of a fixed cost. Fixed cost, again, no matter how many units we make, cost will be the cost. Will not change. So watch out and do not change these numbers. Okay? So it should be across the board, same numbers, 40,000 total. So we take our contribute margin and subtract our fixed cost, and now we get our income from operations. And if the numbers are constant, we should see if we sell more units, our income should be higher as this goes. If something's going wrong and it's completely the opposite, we may want to watch out. Okay. So once we actually do this and create this flexible budget report, we now can actually compare how much we would have thought budget 12,000 would be, and compared to our actual results. So now it's a little bit easier and it's more precise of what's going on. So we can go after this a little bit better. So as you can see, here's our budget, and then here's our actual. Again, this is from earlier, but this is from our new flexible budget. Notice now, the sales income is definitely closer. It's only 5,000 difference than 13,000. Direct material is a little bit closer, 1,000. Still, we're still costing more, so that's stuff right there. Same thing here, but factory supplies has now become favorable. Utilities is unfavorable, but a couple more have become favorable as the actual is less than what we would have budgeted. But this will still bring managers with few questions. So one of the questions is how much did we actually sell per unit? By the rate that this goes, our flexible budget has $10 budgeted, but it seems like we had a higher sales than we did for our budget because we made more money. So when you're trying to figure out this, you have basically just take your revenue, divide by your units, and this will tell us our actual selling price. So we were actually selling our units at $10.42 per unit, which is pretty good. Go with the salespeople, yay! But this also brings in, if we're making more money, why is there so much of a difference between our direct materials and direct labor? Okay, why did we use our more materials, or why did we buy more materials than what we budget? Why is direct labor more than what we actually want? Is there something going on here? Is there efficiencies? Is of somebody getting overtime? But this lets our managers to look at this, go and see if there's needs to be corrective action needed. So that's something that we're going to be looking at a lot when we look at these budgets. This also brings in what is known as standard cost and variances. So right now these are variances too. These are variances. These are a basic variance comparing. We're going to dive a little bit deeper now. Yes, it's going in deeper. We're learning a little bit more. We're trying to figure out the actual why direct materials, direct labor, factory overhead are the way that they are. So, standard cost. What are standard costs? Standard costs are pre-established costs for delivering a product or service under normal conditions. And they are determined by managers, cost accountants, engineers, anybody that actually works and has the expertise and knowledge in it. So, with that being said, with that being said, we're going to dive a little bit more into these standard costs or normal working conditions. And this really takes out and does not take into account any like waste or machine in trouble or stuff like this, but lets us actually kind of look and see if there's some kind of efficiency going on. Let's just pinpoint a little bit more. So these are the standard costs that you will see for each one. Direct materials will have price standards and quantity standards. Direct labor has rate standards and time standards. And variable overhead has rate standards and activity standards. Overhead's going to be a little bit tricky. So with overhead in itself, we're going to basically take that to its side, and we're going to focus at first materials and labor. So with that, you're going to get some information. Now we're going to use an example of ProBat, good old baseball and softball bat company. They're going to produce and they're going to give us standard costs. Okay, this is what their expertise says on how to make one bat. That direct materials standard quantity is 1 kilogram. Standard cost per unit is 25 bucks. And direct labor is 2 hours for 20. And then overhead again is activity based. And we're going to be using direct labor hours. So using 2 labor hours, overhead standard is about $10 per hour. So our product cost should be about 85 bucks if we actually achieve the standard. Oh, you know that ain't gonna happen because we got actual. So this is what's going to happen. This is known as another cost variance analysis. Kind of something that we've already done before in the CVP. So, and this usually takes a few steps, a good old cycle. You know how I like my cycles. Just keep going and going. So again, we love graphics. So here's the graphics right here. First thing that happens is, we're going to always prepare the reports. We're going to get our budgets going. We're going to compare them. And we're going to analyze these variances. Why? Why is it this? Why is it that? Why can't the chicken cross the road? You know, all these variances. The next thing is going to be questions and answers. Okay? We're going to be asking all the whys, the who, what, where, how kind of thing, and trying to find answers. So we're going to have meetings with managers, employees, everything, and from these questions and answers, we can take the corrective actions that we need. From these corrective actions, we can prepare the reports and go through the cycle again until we get to the best we can. No company is going to be the best. So it's going to be a cycle that you just go through like all the other cycles. Lots of reports, a lot of analyzation until either company goes bankrupt or y'all finally find the perfect balance, which is hard because things keep changing. So from there, we do have certain formulas. And this chart right here helps with the formulas for direct materials and direct labor. Now, easy way to read is if it's an S, that stands for standard. A stands for actual. Okay? Again, here's the legend right here for y'all. So, direct materials has a price variance, while direct labor has the rate variance. That's why we have the DM and the DL right over here. So, for direct materials, when we look at their variance, price variance is standard price minus actual price times actual quantity. Okay? Its quantity variance is standard quantity minus actual quantity times standard price. Okay? Direct labor, its rate variance is standard rate minus actual rate times actual hours. Its efficiency variance is standard hours minus actual hours times standard rate. Okay? So, with the truth being told on that, lots of numbers, but this is the thing. We still gotta know if it's favorable or unfavorable. It's really easy with direct labor and direct materials. If actual outweighs standard, then that's going to be a negative that this is going to produce. And if it's negative, it's unfavorable. I mean, we didn't budget correctly. But if it's the opposite, this is going to produce a positive. Means standard is greater than actual in the parentheses. Then it's a favorable. Okay? So positive's good, negative's bad. So again, favorable variance will be positive, unfavorable variance will be negative. So let's dive in, and we're going to go from the probats that just gave us the standard card, and we're going to actually do these formulas based on GMAX company. And this one produces golf club heads. If you happen to not know what golf club head is, here's the actual what is one. Okay? Don't worry, you're not going to be tested on what a golf club head is. Anyway, so their standard costs are this. Direct materials are 5 pounds per unit at $20 per pound, are basically $10. Direct labor is 1 hour per unit at $16 per hour, or about 16 bucks. We will also know this information going on too. So, they used 1,800 pounds of raw material to produce 3,500 golf club heads. They paid $21 per pound for the raw materials, and they worked 3,400 hours to produce the 3,500, don't know why that extra zero is there, golf club heads. Paid an average of $16.50 per hour per hours actually worked. Okay, so a few of these you can already tell actual beat out standard, and we're going to have some negative numbers, but let's compute it as we go. So starting off, price variance again is our standard price, which was $20 per unit, minus our actual. We actually paid $21 per pound. Okay, times actual quantity, which was 1,800. So this really means one right here, as I can see, it was going to be negative no matter what. So this is very unfavorable. Unfavorable by 1,800. Going to our quantity variance here, if you notice, we don't have how many pounds would have been the standard. So we actually have to figure this out. In order to figure this out, we have to take the 3,500 that was actually made, the units that were made, and basically times it by 0.5 pounds. So we got to convert the units to the pounds. Okay? So with that being said, when we do this, our standard would have been 1,750 pounds. And as we can see, our actual again beats it out. So this is going to be unfavorable because it's going to be a negative number. And then times by the standard price of $20. So we really kind of lost $1,000 on this if we stuck to our standard. Again, not great. So when you get the question, what is the total direct materials variance? All you have to do is add your price plus your quantity. And so we have basically a negative 2,800. Okay? So, not good in ways. We got a lot of extra expenses. This is going to be a big thing to ask why. Why? Alright, so let's look at the rate. Alright, the direct labor. Direct labor follows the same path. This was our standard rate, was $16 from our previous chart, minus the $16.50 from actual, and times by actual hours. Okay, so this would have been a negative 1,700. Again, it's unfavorable. I can tell right here. Now, efficiency variance. Again, we didn't have the hours. We don't know the standard hours, so we're going to have to figure those out. And looking up here, whoop, a bit too far. It says it takes 1 hour per unit. So we have to take 1 hour times 3,500 of the units that we actually produced. And we actually come out to 3,500 hours. Now, from there, we can actually produce, again, we can see actual hours actually under our standard. We have a favorable. Yay. So, with the favorable right here, we find out basically 3,500 minus 3,400, which is 100, times 16 is 1,600. So we actually came out ahead on this one than what we were predicting. Again, coming out with our total direct labor variance though, of the 1,700 plus the 1,600, we still didn't come totally out ahead with direct labor. We still lost some money. Lost a good old total of $100. Well, we're going to evaluate these, and these are some of the questions that are actually going to be asked. First off, the direct material variance. The price variance in itself, we're probably going to go to the purchasing department because they're the ones that get the materials. And we're going to ask why materials were purchased for more than standard cost. They have to give us a reason. And if the reason is that somehow the value has gone up on materials, then we have to budget that in our next budget. Helps us out. Quantity, we look at production. The production process used more quantities of material than what was called for. Why? Why did you need more material than what our actual specifications are? And that could be that there were some custom jobs came in. Could be something else. There's a lot of things to answer that question. Direct labor, our rate variance. We may talk to basically personnel, which is HR, or the production manager. And again, why were wages actually paid higher than our budget? And I mean, we could have gotten some specialized people, some extra, but we gotta ask why. And efficiency variance, again, is with production management. And more labor hours were actually incurred to make the units that were produced than were needed per the standard. So, if we thought that we needed this many hours, well, what did you do to basically cut the hours and still make all the products? And Does this mean that the products are still good or are they bad? We're going to have to ask. Notice that the production manager is the one that we're probably going to speak to a lot. So if you ever become one, know you're going to have upper management on your butt. But now let's look at the overhead. Overhead is basically what we're going to end this chapter with. And really, overhead is similar to what we've already done when we're trying to think of if we over-applied or under-applied. But we're going to use it in just a little bit of a different way. So, determine the standard overhead rate. Again, is very similar to predetermined overhead rate, as we've done in prior chapters, and we calculate based on this. Determine the allocation base, choose a predicted activity level, and then compute the standard overhead rate. Not too much going on there. And companies will use a flexible budget again, but with overhead, they like to use more of a capacity level. Again, overhead typically deals with more of factory based. We all know that. So it's dealing with the factory in itself. So we're going to look at capacity. Now, as you can see, this budget starts if the factory's at 70% capacity, 80% capacity, 90, and 100. We already know our variable amounts per unit. And again, it's basically times 3,500 by 40 cents. Same thing as we go through. It's mostly multiplying. Again, we have our fixed costs for the factory as they go through. They are always going to be the same, so not too much different. Now, this is something that you will have. These are the two things that kind of throw in. One, we're going to stay with direct labor hours. It's a little bit easier. And it is, again, 1 direct labor hour per unit. So, 1 times each of these comes out to our hours. All we need to do is take these hours and divide it into our total factory overhead. For us, our example, we're using 80% capacity. So 4,000 divided to 8,000 is $2. That's our standard overhead rate. Okay, our predetermined overhead rate. However, where you want to go with that? So the formula in itself is just like our previous one. So again, total overhead cost at predicted activity level divided by total activity amount. So 8,000 divided by 4,000 is $2. Okay, not too much different right there. Now, again, we would have to compute this in the real world, and that may take a little bit. Okay, the overhead cost variance is formula basically is our standard overhead applied will equal actual units produced times standard amount of allocate base per unit times standard overhead rate. So that definitely means we're going to be using this $2 soon. Okay, and then we got overhead cost variance. This is our variance right here, which is our actual overhead cost incurred minus standard overhead applied. So again, we have to figure out this one first, our predetermined rate, then we get to figure out standard overhead, then we get to do overhead cost variance. Yes, rock on. Now, the bad thing with this is that the way that we know direct materials and direct labor, if this is positive, it will have been favorable. If it's negative, it will have been unfavorable. Overhead, complete opposite. So whatever this equals, if this happens to be positive, is unfavorable. Okay, that means overhead incurred was greater than standard. If this is negative, you got negative overhead cost variance. That's favorable, because that just means standard beat out actual overhead. Okay. And then from there, we do have two other ones. We have the overhead volume variance, which is the budget fixed overhead minus applied fixed overhead. And this really happens when what we budget, what we think we're going to do capacity, is different than what actually happened. Okay? And of course, this is what's going to happen. Okay? Overhead controllable variance is overhead cost variance minus overhead volume variance. So we're going to take this and subtract it from this. Okay? So, and this basically represents the portion of the overhead cost variance that is under control and influenced by management. Thus, we can actually get on management a little bit more. Okay? But it really helps out a little bit more. The sum of these two overhead variances, though, should equal out to our overhead cost variance. Big note there. One, because we actually subtract this one from this, from overhead cost, so they should add up. If they don't, we may need to have some questions. Okay? So, how does this work? Okay, guys, let's do this. For Gmax, we knew the actual units produced were 3,500, which, of course, we were predicting 80% capacity. This one's falling under 70% capacity. Okay, so we're going to be using these numbers for 3,500 units. And you're going to see that happening. So, first thing is, actual units produced were 3,500. Standard amount of allocation, of course, was 1 direct labor hour per unit, and our overhead rate was $2. So we're doing this formula first. Standard overhead applied. So take your actual times your basically activity times by the rate, and we find out that our standard overhead applied is 7,000. Now we're going to just assume that the actual overhead cost incurred was 7,650. So this would mean our overhead cost variance would be the actual overhead, 7,650, minus our standard. And it's a 650. Again, this is positive, but falls on the line as unfavorable. Okay, again, overhead likes to switch things. For our next variances, we have to take these numbers and use it for our other two, that volume variance and the controllable variance. So right here we know that actual overhead costs were 7,650. 8,000 total overhead was budgeted. 4,000 total fixed overhead was budgeted. Again, these two actually popped up from right here. 8,000, 4,000. Okay? So, fixed overhead that was applied depends upon the rate for fixed overhead, which is again similar to up above. We had 4,000 total budget fixed overhead divided by 4,000 direct labor hours. So again, right here, 4,000 labor divided by our overhead. So that basically means $1 of fixed overhead per unit produced. Okay? Thus, $1 fixed overhead application rate times our actual units produced gives us a 3,500 applied fixed overhead. Okay? Now, most of your problems probably on the homework will actually give you this, where you don't have to do this extra, but if it does, I mean, it's really, again, not overly hard. It's just finding predetermined overhead. Now, the overhead controllable and volume variances will take this information. First, it's going to take our budget, which was 4,000, minus our applied fixed, which was 3,500, and finds out that it's a 500 basically unfavorable thing. Again, not great. We wish it was better. Overhead control variance. We take our cost one, which was a 650, minus our volume, and it's about 150 unfavorable. Yay! So again, add these two together, they should equal to 650. Okay? So with this, we have to evaluate, and this is basically the last little part. And evaluating is really taking another report. This is our overhead variance report, and we're going to see where in the process it seems to be screwed up. So we're going to evaluate variance using this report. And as you can see, our expected production level was 80%. We only achieved 70%, so we're going to ask why on that. And basically it's like, hey, we budgeted for 80%, why couldn't we only hit 70? That could be just dealing with sales or other items. Here's our budget fixed overhead, and then here's our fixed overhead applied. Again, this comes out to our volume variance. So this is using this up here. We'll just put it right here. And then you're going to see our flexible budget. Notice again, the numbers are related to the 3,500, the actual achieved. So it's bringing that like flexible budget that we did before and compares to our actual results. And we can actually see exactly what probably caused the 150 right here. That was controllable. And we can actually ask those questions. So, that few of the overhead costs incurred as predicted by the budget. That's awesome. Again, fixed overhead should be the same. And we actually did well on maintenance. The other ones didn't. So, the primary variance in itself was indirect labor. Indirect materials had a 25 favorable. It actually came out a little bit less, so that was good. We didn't use as much materials as indirect materials. Power and lights were $50 unfavorable. Now, these are points where the management will investigate why. Maybe the utility company raised the bill, but the indirect labor is one that we're going to be going, why was it a little bit higher in our overhead? Again, these are ones we want perfectly zeros. We're never going to be perfect on zeros, but we want as closely as possible, and we're going to always ask why. And that's the basis of chapter 21, is going through these these budgets and actually analyzing. The most important parts to this chapter, though, is knowing the standard cost, knowing those formulas, and also knowing the flexible budget, what it is, how can we make it, why do we use it compared to a fixed. Okay, so that's it for chapter 21. If you have any questions, please leave those comments below. I will get to them as quickly as possible. Besides that, this show is over for this chapter. So Counting 22 302 is signing off. And Professor Nergon signing off.